Hey there and welcome to another video. My name is Hugh and this is the updated version to my complete beginner's guide to Forex hedging. Now Forex hedging is one of my favorite trading methods, so I'm going to be teaching you the basics here so you can get started quickly. So a couple things before I get started here. Number one, there is quite a bit to hedging, so you do have to practice. You do have to get your head around it because it is a new concept for most traders because it's not like other trading methods. So I would invite you to take in the information in this video. And the next thing you should do is open a free demo account. Now, if you're not familiar with the demo account, it's a free account that you can open at most brokers. And this will allow you to basically paper trade with fake money. And this allows you to practice and see the concepts in action. Because if you just watch a video like this and you try to go out and hedge, it's kind of like riding a bicycle. You need to actually get on the bicycle and learn how to ride it. You can't just read about how to ride a bicycle. You can't just watch videos on how to ride a bicycle. You have to actually go out and do it. And a demo account is a great way to get started, totally free. You have no risk involved. And that's the best way to start to learn these concepts. And second, if Forex hedging appeals to you, then I would invite you to subscribe to my channel to get more videos like this. And also take a look at my Forex hedging playlist. That will give you all of the videos that I've created on Forex hedging. And that will allow you to see the concepts in action. I show some backtesting, I show some live trades, and I show some other concepts that are important to hedging. Remember, there's quite a bit to this and you have to learn the little nuances, but this guide will get you started. All right, let's get into it. All right, so this is the complete Forex hedging guide for beginners. This is version 3. This is my updated version. So all of the other versions are outdated and I have some additional information in this guide, and that's why I created a new guide. All right, as always, all information is provided for educational purposes only, and this is not trading or investment advice. All right, so what am I going to cover in this video? First, I'm going to explain what hedging is if you're not familiar with it. Then I'll go over the advantages of Forex hedging, common myths about Forex hedging that could be keeping you from utilizing this really powerful trading method. Then I'll get into backtesting chart examples. I'll actually go on the chart and you'll see the chart moving, and I'll show you some of the concepts that I'm going to be talking about here that are really hard to understand without actually seeing a chart. Then I'll get into the best chart timeframes, and at the end I'll give you a link to my free PDF that you can take with you so you can continue your hedging studies. All right, so what is hedging? Well, hedging is a way to limit risk by taking a trade in the opposite direction in a related asset or a similar asset. So in Forex, you can hedge in the same currency pair. You can hedge between currency pairs. Another market that hedging works well in is the options market. So one thing that people do is they do covered calls in the stock market, and that can work really well too. So hedging is basically taking longs and shorts at the same time to limit risk and potentially increase profits. Now, this is not something new. This is not something that I invented. Large corporations use hedging to limit their risk when they're buying commodities and when they're exchanging between foreign currencies. And you might not know this, but hedge funds were originally called hedge funds because they were required to hedge their investments. That's no longer the case anymore, but that's where the name comes from. So that's kind of the background of hedging and what it is. Now, why Forex hedging specifically? Well, retail Forex provides an easy way to hedge without expensive options or futures contracts. So like I mentioned before, Forex is a great market to hedge in, but you can also hedge in the stock market with options or in the futures market with options. However, the downside to that is that you need a pretty big account to do that. And in those other markets, you need two accounts. So you need a account for the futures trades or the stock trades, and then you need a separate options account. And usually you need quite a bit of money in both accounts. However, in Forex, you only need one small account, and that's one of the biggest benefits. And in my opinion, this is the only market where an independent trader can easily get in with a small account. Another benefit of Forex hedging is that it's easy to go both long and short. In some markets like the futures market or the options market, sometimes liquidity is an issue and you have a hard time buying or selling because there are not enough people willing to take the other side of your trade. So that's one of the huge benefits of Forex hedging. Forex also has small spreads and very minimal transaction costs. And hedging is a very flexible way to manage risk. And you don't get that sinking feeling, when you wake up in the morning and you look at your trade and you got stopped out. Because in hedging, you don't use stop losses. Instead, you use hedges to manage your risk. And finally, you can potentially make money in both directions when you're doing hedging. All right, so I've been hedging since about 2010 or so. I don't remember exactly. But these are some common myths that I've heard over the years that prevent people from getting to hedging. And some of these myths actually stopped me in the beginning also. So number one, a lot of people say that you cannot do this in a US account, and that's simply not true. You can do it in a US account. You just have to know the rules and how to get around the rules a little bit. But it is perfectly legal to do it in a US account and if you live in the US. Next, a lot of people say you cannot make money because you're going long and short at the same time. Well, you're not going to be exactly long and exactly short at the same time because that wouldn't make any sense. You're obviously not going to make any money that way, right? So in the examples, I'm going to show you how you can use both long and shorts at the same time, but still profit from it. Another common myth is people say you can hedge in any market, and that's simply not true. And this is because of the mechanics of certain markets. For example, a lot of people say that you can hedge in the crypto market, and that's not true. You can watch my video on that if you want to in the playlist. But in crypto, it's usually the case that you have to pay a lot of carrying costs. So they call it swap or daily interest. And usually that amount that you're paying is going to really eat into your profits. So it's really not worth doing. Same thing with the stock market. If you're going to hedge in the stock market by just hedging stocks by shorting and going long, sometimes you can't get a short on the stock itself. So that's why options are good in that case. But like I mentioned, then you need 2 accounts and you need a pretty high account balance. So hedging straight stocks is not a viable strategy in my opinion. Next, people think that you can automate hedging with a robot. And while this might be possible, I think you're going to need some very complex programming for this, and it's not for the average individual. I only know of one case where it might be possible, but I haven't actually seen any proof that it is possible. So in my opinion, hedging needs to be done in a discretionary manner. You have to call the shots, you have to take the trades, you have to make the decisions. And I know it's a very sexy idea to think that, I can just create this robot that'll make money while I sleep, but that's not the case for hedging. Robots only work, in my opinion, when there's a fully automated trading strategy. And this is very much a discretionary trading strategy. So you need to understand that. And finally, some people say that hedging produces 100% winners. And that is simply not true. That is not the case in any market with any trading strategy. You're not going to have 100% winners. But with hedging, you can have consistent returns because you are managing your risk and you have the potential to make money in both directions. But the idea that hedging produces 100% winners is a myth. And the only people who are probably making 100% winners in hedging are the people selling those robots that tell you you can make 100% winners. So that's simply not a true statement. All right, that's enough of the slides for now. Now I'm actually going to jump on the charts and show you some of these concepts in action so you can get an idea of how this works. And I'm going to give you 4 examples of hedging. So number 1 is going to be the common myth of hedging. Number 2 is a simple hedge. Number 3 is the concept of a roll-off, which is very powerful. And number 4, I'm going to show you an example of making money in both directions. All right, so here is a chart. And the first thing I want to demonstrate is the common misconception about hedging. And that is you're going to have a long and a short at the same time. So I'm going to take a trade here on the chart. I'm going to buy, let's do 1 standard lot. And then let's move the chart a little bit. And then I'll sell 1 standard lot. Right? Okay, so this is what most people think hedging is. They think that you're just going to leave these 2 trades in place. And as you can see on the bottom, there's no change in the profit or loss because you are long and short the same amount at the same time. And that simply doesn't make any sense. So that's not what hedging is about. Now I'll get into what hedging is about. All right, so this is a super simple example of how to hedge. There are many ways to do it. I actually teach 8 exits in my Zen 8 Forex Hedging program. All right, as an example, let's take simple support and resistance. So I've drawn this potential support line here. Price has already bounced off. So this might be a good place to go long. So I'm going to buy 1 standard lot. All right, so one way to do this is you say I have an upward bias, right? Because price is in an uptrend and it's bouncing off this potential support level. And remember, in a traditional trading strategy, you would probably put your stop loss around here. So let's take a look at this example and how hedging can be an advantage. Okay, so price is initially going against you and boom, price closed below the low here. So ordinarily, you probably would have gotten stopped out here. But at this point, you could hedge with a sell. Okay, so now there's a sell and a buy. Now you're not going to lose any more than what's between these 2 trades. Now, since you're fully hedged, you have some time to look at what the market is going to do. And a lot of times the market will give you some clues as to where it's going to go next. So you just have to let those candles unfold and see what's going on. Okay, so now it looks like it's going to bounce off that level. So one way to play this is you could actually take another buy here because you think that price is going to go up. So now you have 2 buy positions and 1 sell position. And this is the first concept of hedging. You don't have to be 100% hedged all the time. A lot of times you want to be slightly biased in one direction or the other. now that the direction is a little bit more confirmed, it's not a guarantee obviously, but this is a pretty strong move here. So now you can be a little bit more biased in the long direction. So if you move this forward, price in fact does go up, and I'm going to close this out and I end up with a net profit even though I was hedged. Now another way you can do this is you can actually take this first trade right here, and then you can use a hedge as a stop loss. So this method is great if you want to put on a trade and you have to go to sleep and you want to be sure that you're protected from a big move overnight. So you can just put a pending order right below maybe this swing low. So I'm going to put in a pending order below that level. So this is going to be a sell stop at price right around here. Place the order, and you can go to sleep knowing that you can only ever lose what's between these two trades if price does get down there. So I'm going to move the chart forward, and as you know, price is going to bounce and head back up, and you can close out this trade at a profit, and then you can close the pending order also, and that will get you to flat and you don't have any more trades. Okay, so again, these are very simple concepts, and this is just the beginning of how to hedge. But I hope you can see that there is some potential here, and you don't have to be 100% hedged all the time. All right, the third concept I want to show you here is the concept of a roll-off, and a roll-off is huge. That really changes the game when it comes to hedging, and that is the idea that you're going to take the profits from one trade and lessen the position of another trade, or completely close out a losing trade altogether, and together it'll be a net profit. All right, now let's say that I made $1,000 on this trade, but I was also losing $200 on another trade. So what I could do in that case is I could close both trades out. I would net positive $800, and I would get rid of that losing trade on the other currency pair. All right, another thing I can do is I can roll off within the same currency pair. So let's say that I took this same trade again, but this time I put a hedge in, maybe below that last swing low. So I'm going to do a sell stop. I'm going to place that right there. Okay, so as I move the chart forward, I get taken into the sell. Now I'm fully hedged here, and then price takes off in the other direction. And let's say I exit there. Now in this case, I don't want to close both of them at the same time, right? Because there's going to be a net loss because of the loss that's locked in here. So what I can do in this case is I can close the winning side. So I'll close that order, and then I can take some of the losing position off and lessen the lot size on that losing trade. So I made 1.19% there. So let's say that I take off half of that losing side. So that's 0.5 here. So in this example, I lessened the losing side by 50%. I took off half a standard lot, and I still came out with a net profit. And my losing side is less. And now I can start looking for another trade in this currency pair or another currency pair that can offset the loss here. And the beauty of this is that the losing trades get smaller and smaller gradually, and you take a net profit every time, and slowly the losing position gets smaller until you can finally roll it completely off. Now finally, the last thing I'm going to go over is making money in both directions. So in this example, let's say that you thought that was a good place to go long, so buy there, right? Okay, now price moves forward, and again, we're just looking for additional clues that the market's going to give us. Sometimes we can get in early, so we need to take a look at what the market's doing. So at this point, maybe you think, okay, this is a potential resistance point, and what you could do here is you could actually sell here. Now, when you sell there, your locked in loss is actually very small, right? So there's a lot of potential with this. So now as price goes down, and we know this because we've seen this before, but now you could take a profit on the sell side, close that order, and then you can wait for price to do its thing, and now you see, okay, it's potentially going to go back up again. So then you put in another pending hedge down here just to limit the risk. Right, so now you're covered just in case price goes down, but you haven't actually entered another sell trade to hedge yet. So you just keep that one in place, and boom, the market goes up, and then you can close this one at a profit. Now, obviously, it's not going to work perfectly like that all the time, but this is an example of how you can use hedging in both directions to potentially make money. Now, the danger here obviously is entering too many trades, and I see traders do that. They enter too many trades. So you really have to be disciplined in having a maximum number of trades that you're going to take in a particular area on the chart, and you have to be disciplined about the risk management. And that's something that comes with practice and learning more about hedging. But this is just a really simple example of how you can make money in both directions. All right, so now you can probably see why hedging can be so powerful and why it does take a little bit of practice to figure this out. In previous versions of my hedging method and my hedging course, I had mentioned that I was making upwards of 1% a month pretty consistently with hedging on a higher time frame. But I found that when I moved down to the 1 hour, that's when things started to pick up. And now I make upwards of 5% a week. Now that's not going to be typical for everybody, and I don't make that every single week. But I just want to show you that that is possible when you move down to the lower time frames. So I like the 1 hour time frame. But again, this is very much about what works for you, what works for your personality. So you could try the 1 hour, you can try the 4 hour, you can go down to the 15-minute or whatever. And again, this is where demo trading and simulation trading really helps. So you can understand the ideal chart time frame for you. If you have less time, maybe you have a family and you have a demanding job, then you might want to go up to the 4 hour. But if you have some time to watch the charts, or you only set out a certain amount of time to trade every day, then you could drop down to the 1 hour or the 15-minute. Now for me, the issue on the 4 hour was that I wasn't getting enough trades. So I would have to wait a long time before price either hit my hedging point or my take profit. And it was just taking too long. But when I moved down to the 1 hour time frame, that's the best one for me because it gives me results fairly quickly. I'll know if I'm wrong or I'm right, and I can act appropriately. Now, if the 4 hour or the daily doesn't work for you, you can also create custom timeframes on certain trading platforms. So you could create like a 2 hour chart or a 3 hour chart or a 12-hour chart. And that's a great way to create a more viable time frame for you. All right, before I get to the PDF download, I just want to review the benefits of Forex hedging. Again, retail Forex provides an easy way to hedge without expensive options or futures contracts or multiple large accounts. It's the only market that I know of that independent traders with a small account can get started safely. It's easy to go long and short in Forex, unlike other markets. The spreads and transaction costs are small in Forex. It's a very flexible way to manage risk, and there's no sinking feeling of that stop loss getting hit and you're like, oh, this isn't going to work out, right? So this can help with that problem. And finally, you can potentially make money in both directions at the same time, which is a huge benefit. All right, if you found this tutorial beneficial, the best way to support this channel and this information is to share it with somebody who you think would benefit from it. Share it in groups, share it with your friends, anybody who you think would be interested in hedging. Again, hedging does require studying. It does require quite a bit of practice, just like any other trading strategy. There are no free lunches. So if you want to continue on your hedging journey, be sure to download my free PDF guide, and that's something you can take with you, put on your phone or whatever, and you can start learning more about how to hedge in the Forex markets. So if you like this video, be sure to give it a thumbs up. If you want to get more hedging videos, be sure to look at my Forex hedging playlist. Subscribe and hit the bell to get more hedging videos. And thanks for watching.